In this video, traders, we're going to look at the difference between synthetic and native order types. Stay tuned. Hey traders, a warm welcome to you. So if you trade directly on the exchange, for example, the CME, you will know that there are different order types you can use, and your broker will offer you a different selection of order types. Now, some of these are called synthetic and some of these are called native. It's important to know the difference because there's a difference in how they're executed, what they mean, how they hit the exchange, all this kind of stuff. Now, if you're not trading directly on the exchange, you're trading against a counterparty like a spread bet broker or CFD broker. These won't apply to the orders that you place with your spread betting broker or CFD broker, are just orders supplied to you by the broker. And of course, you're trading via a CFD or a spread bet, which is your contract with your broker. They then choose to go to the market or not, depending on their hedging requirements. I've done a video on that before. All right, so let's have a look. So for example, if we're looking at the CME, Chicago Mercantile Exchange, we have native order types, which are limit orders, market orders, and a difference of those. We have a specification on price. That's our limit order. Market order just says get me in at whatever price possible. We have stop orders as well. Those are the three big ones, and of course they will be native to the exchange. We also have stop limit as well, so you can have a stop with a limit on it. Instead of going stop to the market, you can have a limit to that. And then we've got time parameters, which are here, which are good till cancelled day. So these are related to these orders, but they're kind of attributes you can put to the order. We talked about good till day, good till cancelled or day orders before. Fill or kill. In other words, if you can't fill the whole order, then kill the order. That's native. And also iceberg, which is I say relatively new. It's probably been in quite a few years now, but iceberg used to be synthetic order types, where they'd show a specific chunk of the order, then keep reloading the order until the whole iceberg was filled. Called iceberg because you only showed the small bit of order above the top of the ocean, and below was the big order. And that used to be synthetic. Algos used to program because it was so popular. Exchange was like, listen, it's a good way really of us being able to facilitate large order flow without spooking the market. They made those native. Okay, so when we talk about synthetic, so basically before we go to that, native means that the order will sit on the exchange. So in other words, if you place a sell stop order in whatever years you're trading, S&P 500, ES, futures, then it will sit there on the exchange. Assuming your broker does transmit it. Your broker could also treat it as a synthetic and then send it when it's ready, but most of the time the broker is going to say, well, if it's a native order, we can put it on the exchange. So what that means is that order will sit on the exchange. So if your broker server goes down, your computer goes down, as long as the exchange is still up, that order will be executed. If it's a synthetic order type, it won't be sitting in the exchange. It won't be sitting there ready to be filled, and it means that if the broker's server goes down, they can't send the order to the exchange. Subtle differences, but it's important. Also, from a limit perspective, of course, a limit is native to the exchange because it's going to stack you in the order book, and we've got a price time priority. So best price goes to the top of that, then after that it's the best time, then the next best price, the next best price, best time, etc. You get the idea. Right, so now we look at synthetic. So really there are probably hundreds of synthetic order types, and really all they do, guys, is they just kind of create little different parameters based around these core orders. So there's nothing different rather than you're basically buying or selling, right, or at a specific price or at a specific volume. So you can do things as synthetic orders like trailing. So trading stops, which we know just ratchet up as the price goes in a direction to lock in the profit. Trading limits are available as well. In other words, exactly the same as a stop, except you're buying on a pullback in case of a trading buy limit. Then we've got things like time slice, that's a C. Time slice, in other words, executing order based on how much time has gone by. So let's say it executes, I don't know, 10 contracts every 5 minutes until the whole order is done. We've got volume sliced as well, so it's taking the parameters from the exchange and saying, okay, well, for every 100 contracts we trade, this order will execute 2 contracts. So then 300 go, it does 6, etc. So it slices the order up based on the amount of volume coming through as opposed to time. And we've got things like being able to cancel orders and fire orders based on different parameters. So the time of the order, so the order might be cancelled after a certain period of time. So cancel it before 2 hours after the open, for example. So you could put that parameter in that cancels the order. That would be a synthetic order type. Or you could do, now one thing to note, guys, is actually, depending on how it's set up, it could be that you have a limit in, and an order to cancel it is a synthetic order that will adjust that limit. The limit will still probably stay on the exchange and be native, but the cancellation part of the order will be synthetic. Very subtle difference, and we're kind of splitting hairs here. So anything that will cancel or enter an order, fire an order based on time or based on volume, generally speaking, will be synthetic. Now, obviously, an order that's fired into the exchange will be a synthetic order, even though it will go directly into the exchange. For example, hey, I want to fire an order in at this specific time. I want to fire an order in when the bid does this, when the offer does this, when the price pulls back this amount, when the volume is this. Any parameter that you can get from the data that the exchange shares with you, you can normally create an order that does something based on that. And again, that would be synthetic, but it then would fire a limit or a market via a native order. And then we've got things like modifying orders as well. So if price gets to here, then do this, split the order up, cancel the other order, cancel this, do that, all sorts of different parameters. So really, the sky's the limit in terms of synthetic orders. Some of the bigger institutional grade platforms have very complicated orders that are basically algos. You know, they're working for the whole day. It's one order type. Simplifies the execution process for the trader, but if you're executing big size, then you can use one order type that maybe time slices it across the whole of the day, volume slices it across the whole of the day, iceberg if you're going native. So there are all ways of either executing size without being detected, which is the main thing for institutions, is the big thing of I want to be able to trade size without influencing the market or being detected, or just having different strategies wrapped up into an order that don't rely on a human being element of it. Anyway guys, that's native, synthetic orders, different order types. Take care, see you next one, bye bye.